Welcome back to Economic Insights, the weekly deep dive into the financial markets. I'm your host, Alex, and I'm joined today by Selim, market veteran and our show producer. Selim, what a week we just had in the markets. Where do we even start?
Well, Alex, we start by acknowledging that the tech sector decided to give back almost $1 trillion in market value. So, yeah, let's talk about that.
A trillion? That's a staggering number. Is this just a correction, or is something more fundamental happening here?
It's definitely both. We had conflicting signals all week: strong data, weak data, the job cuts data that blindsided everyone. But let's be specific about the tech story because it's the headline. The eight most valuable AI related stocks lost about $800 billion combined since last Friday. That's the worst week for the tech heavy NASDAQ since the tariff blitz back in April.
So, what triggered this specifically? Was it earnings? Valuations?
Valuations mostly. These companies are spending hundreds of billions on AI infrastructure, borrowing heavily to fund expansion. Meta, Alphabet, and Apple borrowed close to $60 billion just in the past 3 weeks. Meanwhile, markets started asking the hard question: when does this actually generate returns? The capital expenditure numbers are massive. Four tech giants reported a combined $112 billion in Q3 capex. At some point, people wonder if they're chasing a mirage.
And retail investors? I thought they usually buy the dips.
They stayed on the sidelines this week, according to some sources. That was actually notable. When retail checks out, the selling becomes reflexive.
How bad did the stocks actually get?
Down 3% for the week on the Nasdaq, its worst 5-day run since April. The S&P 500 itself had its worst day on Wednesday, down 1.17% since early October. But here's the interesting part. The week's really a tale of three acts. Monday, Tuesday, the Magnificent Seven popped on news of an Amazon OpenAI deal. Wednesday, massive risk-off correction on valuation concerns. Then Friday, there was a late-day rally hoping for a government shutdown resolution.
The government shutdown. That's been dominating everything, hasn't it?
It's now the longest on record, Alex. And while it's a political mess, it's also a markets mess, because we're not getting official economic data. The Supreme Court is meanwhile hearing arguments about Trump's reciprocal tariffs under the International Emergency Economic Powers Act. The judges, even Trump-friendly ones, were pushing back hard on the White House's argument that they have this sweeping authority.
What does that mean if they strike them down?
If the Supreme Court reverses the tariffs, it temporarily lowers the effective U.S. tariff rate by about 1.5 to 2 percentage points. But, and this is important, the administration would move swiftly to use Section 122 as a temporary replacement and build a longer-term framework. So it's not like tariffs vanish, they just get reshuffled. The market's betting on at least partial strikes against the tariffs, which created some uncertainty.
On the positive side, you mentioned stronger data midweek.
ADP payrolls came in at 42,000 in October, which beat expectations. ISM services jumped to 52.4, but then the challenger job cuts report hit like a sledgehammer. 153,000 announced cuts in October, the highest since COVID. Looking at the details, UPS cut 48,000 workers, tech cut 33,000, likely tied to Amazon. Strip out those two, and the number doesn't look as apocalyptic, but still, that's a shock.
And that shifted expectations for Fed rate cuts?
Exactly. After the midweek rally on good data, December rate cut odds fell, but then the job cuts data pushed them back up to 70%. The Fed's data dependent, and the data's giving them mixed signals. Meanwhile, retail investor confidence, the University of Michigan survey, hit 50.3, near record lows, with a spike in unemployment fears.
Let's move into the developed markets. US first, obviously. You mentioned the government shutdown is creating data gaps. How much of a headwind is that?
It's a real problem for Q4 GDP forecasting. The current consensus is still holding at 1% quarter on quarter growth, but without the official labor data, that's a guessing game at this point. The ISM Manufacturing Index actually declined to 48.7, which is weak. Below 50 is contraction territory. ISM services is stronger at 52.4, but that services prices paid component just hit 70.0, the highest since October 2022. That's a warning sign about sticky inflation.
So inflation is not dead?
Not even close. The consensus view is that inflation stays around 3% near term because labor markets remain tight and tariffs are feeding through to prices. The Fed cut 25 basis points recently, but they explicitly pushed back against the idea that more cuts are coming. Powell called it driving in the fog, data dependent but cautious.
There were some noises from the funding markets. Tell me about that.
Repo rate surged on October month end, but has normalized since then. The Treasury's cash balance, which hit $1 trillion and is above its target amount by $150 billion, is expected to reduce funding pressure. But the Fed is keeping a close eye.
Let's move to the UK. The Bank of England had an interesting decision.
It was a 5 to 4 vote to hold rates at 4%. Four members wanted an immediate 25 basis point cut. That's a tight vote, and it's decidedly dovish even though they held steady. The MPC removed the word careful from their forward guidance. That's a significant language change. They also explicitly shifted their risk assessment. They said risks to inflation persistence are less pronounced now, and downside risks from weak demand are more apparent. Governor Bailey held what looked like the swing vote, saying he wanted to wait for key data releases before moving.
So we get a cut soon?
Almost certainly. This is about sequencing, not direction. Bailey wants to see the autumn budget and incoming data, but the market's pricing a cut next time they meet. This was basically the BOE saying, we're done holding.
And the Eurozone?
The Eurozone is doing its typical thing. Soft indicators look great, hard data looks soft. There's a persistent divergence there. Q3 to Q4 growth is expected to accelerate, but it's not exactly roaring. The European Central Bank has its own challenges with fiscal divergence across member states, which constrains what monetary policy can do. It's a complicated picture. However, there are some signs that disbursements from the defense spending fund in Germany have commenced, generating a much needed push to the economy. The better than expected PMI figures may be a consequence of that.
Japan?
This is where it gets interesting. Well, as interesting as it gets. The Bank of Japan minutes showed a split board on the concept of underlying inflation. So even within the BOJ, there's disagreement about what's structural versus transitory. More concerning, real wages fell for the ninth consecutive month. That's deflationary. You've got the yen strengthening on these safer haven flows during the tech sell-off, but the BOJ's intervention threshold probably hasn't been hit yet. Intervention would require a faster move higher. For now, they're watching.
Let's talk more on currencies and commodities. What's driving moves there?
The yen's been a safe haven bid during the tech volatility, but as I mentioned, we don't seem to be at intervention levels yet. The yen's correlation with fiscal risk repricing and near-term BOJ expectations is the key driver. If we see US labor market deterioration accelerate, you'd expect faster yen appreciation. That said, longer-term expectations remain for gradual yen strength, driven by lower hedging costs and eventual dollar weakness, so this repricing could last a while.
And gold? That's had an interesting week.
Gold's consolidating around $3,850 to $3,950 per ounce after hitting $4,358 in October and then pulling back on profit taking. But the story is intact. Sustained macro risks, doubts about US debt sustainability, questions about Fed independence and credibility are all packed and labeled as the debasement trade. That's what's driving speculative gold demand. If the Fed actually cuts rates again in December, despite inflation still being above target, that's another tailwind for gold.
Central banks are still buying gold?
Absolutely. Central banks have added 6.7 million ounces year to date and are expected to surpass 10 million ounces for the full year. They're diversifying away from dollars. But the bigger story, debasement trade, is carrying the day.
Oil, copper?
Oil's tracking on trade uncertainty. Tariff concerns keep it volatile. Copper similarly rides on trade and China growth expectations. We don't have a huge move story there this week, but both are linked to the broader trade thaw between the US and China, which is moderately positive. China suspended retaliatory tariffs on U.S. agricultural products after Washington cut fentanyl related levies on Chinese goods. That's the kind of off ramp that usually helps commodities.
Okay, let's move to emerging markets. Turkey's been a story for a while now. What happened this week?
Turkey's inflation came in below expectations at 2.55% month on month, easing the year on year rate to 32.9%. That's still high, but it's a work in progress. The central bank has committed to maintaining tight financial conditions with a high real interest rate buffer. But here's the key: they just revised their end 2025 inflation forecast up to 32%, acknowledging that the disinflation process has lost momentum. Analysts think their interim 2026 target of 16% is too optimistic. They're forecasting inflation between 20 and 24%.
Will the rate cuts continue?
The easing cycle is expected to be slow. Analysts are anticipating 100 to 150 basis points of cuts at their final monetary policy meeting this year. That's not aggressive, but even that is notable. The food prices are particularly sticky. They contributed 0.9 percentage points to the monthly read, with food inflation at 34.9% year on year. Producer prices are also elevated at 27% annually, so there's cost driven pressure throughout.
Let's move to Mexico. Banxico cut rates.
25 basis points to 7.25%, but it was a 4-to-1 vote. The dissenter wanted to hold. More important than the cut is the tone shift. Banxico signaled a more cautious stance going forward. They're contemplating a break in the normalization process. The October inflation report showed core inflation stubbornly stable in the 4.2 to 4.3% range, and they revised their core inflation forecasts upward through quarter two of next year.
So, where's this headed?
Experts anticipate one final 25 basis point cut in December, then a pause in Q1 before the cycle resumes toward a consensus terminal rate of 6.5% by mid 2026. But they have to maintain credibility. Operating at a neutral monetary stance while inflation's still above target is tricky. You're betting on structural factors to do the work rather than more policy tightening. It's a balancing act.
Czech Republic and Poland, what's the picture there?
Czech National Bank held rates at 3.50% in November, maintaining a hawkish stance. They see ongoing inflation pressures as precluding further cuts. Core inflation is expected to remain elevated. Meanwhile, Poland's national bank cut rates by 25 basis points to 4.25%, but analysts are calling it a hawkish cut because of the wide fiscal deficit. That's an interesting characterization, a cut that signals caution. Poland's Q3 GDP growth is expected to be robust at 3.5% year on year, but the fiscal story might limit further easing.
And South Africa?
South Africa is announcing a major budget next week, and the story here is actually quite positive. The fiscal outlook is improving thanks to revenue outperformance and expenditure restraint. VAT collections are up 11.5% year on year due to stronger consumption from lower interest rates. Corporate income taxes are strong thanks to commodity price rallies, gold and platinum particularly. Meanwhile, government outlays in the first half of the fiscal year rose only 5.8%, well below the budgeted 8.2%.
That's disciplined spending.
Very much so. The National Treasury's cash reserves should be stronger, creating room to reduce domestic bond issuance. That said, the debt to GDP ratio will likely see a near term upward revision due to lower nominal GDP growth. It's not all good news. But the government's planning structural reforms. Let's see how far they go in those efforts.
And last but not least, India?
India's CPI is expected to fall to a record low of 0.4% year on year on Thursday. That's driven by eased vegetable prices and benign grain prices. Core inflation should ease sequentially as GST rate cuts offset the rise in gold prices. That's the kind of deflation that lets central banks ease, and we will be watching the RBI closely for more policy hints.
So, what's coming next week? What else should our listeners be watching?
The biggest overhang is still the government shutdown. All eyes are on Washington for negotiations. Republicans and Democrats are working through minibuses to fund the government while hashing out a larger deal. The Democrats' latest effort fell through on Friday. though there was some optimism. That's going to dominate the news cycle and could drive market swings.
What about the Supreme Court and tariffs?
The justices seem skeptical of the administration's authority to raise those broad reciprocal tariffs. We could get a ruling or at least clearer signals about where the court's heading. That's a huge variable for markets.
Fed speakers?
Busy schedule. Multiple Fed officials will be speaking, so we'll get plenty of commentary on the economic data, labor market, and inflation outlook. Investors will be parsing these for signals about December's rate decision.
Are we getting any notable data releases?
UK releases Q3 GDP and labor market data this week. India's CPI is Thursday. South Africa's budget announcement is huge for that market. Overall, though, the US data calendar is sparse because of the shutdown. That's actually creating more volatility in some ways. Without fresh data anchors, markets are just reacting to sentiment and noise.
Last thought. What's the key takeaway for investors heading into next week?
Tech valuations are being questioned, and that's healthy or scary. You tell me.
Ha 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 ha.
The main risks are political, the US shutdown and the tariff ruling. The markets are not panicking yet, but some cracks are showing up.
Don't forget, folks, we do not give investment advice. For that, please consult a professional.
Exactly. This is analysis, not guidance.
Thanks for being here, Selim.
Thanks for having me, Alex. See you next week.